In the first quarter of 2026, while much of the airline industry is struggling with the costs of post-pandemic expansion, Allegiant is pursuing a different strategy. The company posted a net income of $42.5 million for the quarter, a 32% surge compared to the same period last year. Despite these record profits, the airline is aggressively trimming its map. They are cutting 61 routes across their entire network. Nearly half of those eliminations come from a complete exit out of 4 major markets: Oakland, Norfolk, Fort Lauderdale, and Los Angeles. Leaving Los Angeles is a notable move. LAX is one of the highest traffic aviation hubs on the planet, a location where competing airlines usually fight for years just to secure a single gate. Allegiant is moving away from the typical pursuit of market volume. Instead, they are prioritizing the margin on individual routes, trading a massive footprint for a more resilient bottom line. For an ultra-low-cost carrier, the business relies on keeping ground operations inexpensive. To offer the lowest fares, the airline has to operate in environments where overhead is minimal. An Allegiant ticket to LAX costs $88, while a legacy carrier charges $303. Capped at double digits, the profit margin is tiny. After subtracting fixed costs like fuel, crew, and maintenance, barely any capital remains to pay the airport for the right to land. This brings us to a specific line chart tracking LAX operating fees. By 2031, the projected per-passenger cost at LAX is expected to reach nearly $64. If the airport takes $64 out of an $88 ticket, the route is no longer viable. The exit from Minneapolis-St. Paul involves a different calculation. Allegiant isn't leaving the Twin Cities because of rising runway fees or poor performance. In May 2026, Allegiant closed a $1.5 billion acquisition of Sun Country Airlines, which is headquartered in Minneapolis. Maintaining independent Allegiant flights out of the same hub became a redundancy. By stepping away from these high-cost markets, Allegiant can allocate its fleet to regions that sustain its 32% profit growth. It is a retreat by design, trading market share for margin protection. While 61 routes were cut, the airline is introducing 49 new ones. The resulting network is smaller, but more intentional. They are establishing service at 8 new airports, including a move into major secondary hubs like Philadelphia. Florida is the center of this overhaul. Allegiant is removing 34 routes across the state, including several out of Fort Lauderdale, and replacing them with 8 high-demand nonstop paths launching in late 2026. This migration targets regional airports. These locations are often more eager for tourist traffic and charge lower fees, creating the low-cost environment necessary for an $88 fare to remain profitable. Finding an $80 ticket out of a massive international hub is becoming a logistical impossibility. Securing these base fares now requires a shift toward the quieter corridors of regional airfields. The 2026 overhaul is the moment Allegiant chose to stop chasing raw size. By walking away from expensive runways to protect their bottom line, they've turned a strategic retreat into a competitive advantage.